The latest ADP report shows U.S. companies added more jobs in September. Today's numbers show an increase of 91,000 jobs last month. This follows a revised 89,000 gain in August. For a closer look at today's numbers, we're joined by Nigel Galt, chief U.S. economist at IHS Global Insight. Nigel has more than 20 years' experience in economic analysis and forecasting. He joins me now from Lexington, Massachusetts. Nigel, welcome back to Bottom Line. Always a pleasure to have you on.
Thank you. Good afternoon.
Nigel, the job gains, they haven't been sufficient enough to bring down the unemployment rate, which is held at or above 9% for 26 of the past 28 months. What will the jobs picture look like in the intermediate term? Will we continue to have persistent structural unemployment?
I think we're going to have a very high unemployment rate for a long time. I mean, in the near future, the next several months, I expect to see the unemployment rate rising rather than falling. And then I just don't see the economy being able to generate the sort of rapid growth. We'd need to see the economy up to 4% growth rates, that sort of thing, to make really rapid inroads into unemployment and see really rapid job gains. And I just don't see any prospect of that sort of growth.
Nigel, when you say you see the unemployment rate rising, what's the figure you're looking at?
Well, we're going from the level just above 9. I think we creep up to 9.3, 9.4. I mean, I'm not looking for recession. If I was calling for that, I'd be going for around 10%. I think that's a possibility, not our base case now, but 9.3, 9.4, something like that, early part of next year seems quite likely to me.
Nigel, how can this economy stand a hit like that?
The economy at the moment is it's staggering forward. This means that we'll have anemic job growth. It means that consumer spending won't be growing fast. It means the housing sector won't be rebounding. It means that at best we stagger forward with growth barely above zero over the next couple of quarters, I expect.
Nigel, the hiring that we are seeing right now, is it broad-based or is it more targeted to specific jobs, those where the need is most pressing?
Well, I mean, the hiring is mostly in the service sector as usual. We're seeing the usual sort of hiring that you would expect in areas like healthcare, which perennially generates 30 or 40,000 jobs per month. Outside healthcare, I think it's fairly broad-based, reflecting some companies who can't generate enough productivity growth to grow without adding people. So I think the rest of it, apart from health, is fairly broad-based service sector growth.
Oh, Nigel, as you well know, the ADP numbers, they don't always predict what the government's broad employment report will reveal. That report's going to be released on Friday. What are you expecting?
Well, we're a little more pessimistic than the ADP number. We're looking for 25,000 jobs total. 70,000 private sector, including Verizon strikers coming back. So we're only looking for 25,000 private jobs. And we expect, unfortunately, government employment will be falling again. We're looking for another steep decline there, a loss of 45,000. So we think it's going to be a pretty grim report.
We have a report out also today by Challenger, Gray & Christmas, and it shows U.S. employers announced the most job cuts in 2 years in September. And those cuts, as you just intimated, were led by planned reductions at Bank of America and in the military. Are these job reductions a sign of things to come?
I think on the government side, we've had a lot of job cuts already, and there is more to come because it's no longer just state and local that's cutting. The cuts, as you just said, are spreading to the federal sector. So it is indeed a sign of more to come on the federal side. And I think not surprisingly in the financial sector, given recent strains, we're seeing some of it show up in job reductions there. So I do think this is going to set a pattern that we'll see repeated over the next several months.
Nigel, can you explain to people, it seems that almost a trickle-down effect, because if we're not having these jobs, that also affects the anemic housing sector as well, because if there's no job, that means there's no construction jobs either.
Yes, I mean, the biggest problem on the housing side is even though we have slashed housing construction, so we're not building many new homes, the demand for new homes has plunged. There's no household formation, or virtually no household formation. People are doubling up. There's less immigration because there's less job opportunities. until we see employment start to revive, we're not going to see household formation revive, and in turn we won't see housing demand come back. So the two are very, very closely linked.
Nigel, during testimony yesterday before Congress's Joint Economic Committee, Fed Chairman Ben Bernanke said, quoting here, recent indicators, including new claims for unemployment insurance and surveys of hiring plans, point to the likelihood of more sluggish growth in the period ahead. At this point, is the Fed's role to ensure price stability or to do what it can to bring down the unemployment rate?
I think right now the focus for the Fed should be the unemployment rate. I think given how weak the economy is, that certainly in the near future, price stability is going to take care of itself because price pressures are diminishing. We can see it in commodity prices, and I think we'll see the same in core prices. So the Fed right now, focus should be on unemployment and whatever it can do to stimulate growth.
Speaking of price stability and the Fed, is there an inflation level that we can live with?
An inflation level that we can live with. I mean, longer term, clearly we'd be happy with the Fed's target 1.5% to 2%. But I think we'd be actually quite happy if we could generate enough growth to temporarily push inflation above that level if it was being generated by stronger demand growth. So we are happy to see positive inflation. The one thing we don't want to see slipping back into deflation.
Nigel, as you're no doubt aware, in a week, actually a week yesterday, Bloomberg and the Washington Post are going to be co-sponsoring a Republican presidential debate at Dartmouth. The topic is going to be jobs and the economy. What do these candidates need to tell the American people going forward about how to deal with this economy and how we right our fiscal ship?
And what they need to tell people and what they will tell people may be somewhat different things.
No doubt.
I think they'll be telling us that the way to generate jobs is to reduce the role of the government, cut back the government, and let the private sector take over. I fear that the message may be a little simplistic because if we look at what's been happening recently, the government has been getting out of the way. Government spending is being cut. Government jobs are being cut, and the problem right now is the private sector isn't ready to take over.
Nigel Galt, Chief U.S. Economist, IHS Global Insight, joining us from Lexington, Massachusetts. Nigel, it's always a pleasure to have you on. Thanks so much for your insight today.
Thank you.